Hello, ladies and gentlemen. Thank you, Erez, for the introduction. Does this work? I'm Alan Langner. I represent Tech Financials. I come from a derivative trading background, mostly in hedge funds and other proprietary trading institutions. And I joined Tech Financials to design the pricing engine and risk management methodology. Today, I will speak to you about key trading elements for successful brokers. But before I start, I would like to touch on a misconception that exists in the binary option industry. This misconception is that brokers know what they want. They might know what they want, but I am not so sure that they know what they need. I'm not just saying they're less than smart, they're probably smarter than us because they have to bring in the business and we just play with numbers. The reason I'm here today is to go over some basic elements that comprise the customer or the trader's total experience trading options in order to optimize the business. The brokers have their own notions about what kind of assets they should trade, or the commission they should charge, or the payouts they offer. Also about risk management. There's a lot of misconception about risk in the binary world. But let's start with the first element. The first element is the option preference, which comprises of which options they prefer trading. Would they prefer major assets like dollar, euro, pound, yen, major currencies, perhaps gold, oil? The vast majority of the business do trade these very popular assets. And on the other hand, there are more exotic assets like IPOs that come to the market and other special events that get a lot of media traction. Also, do they prefer trading short-term trades, or they prefer longer-term contracts and instruments that they might prefer? The second component that I will focus on is commission percentage. What is the correct commission brokers should charge? And more importantly, is the same commission applies to all brokers? And the last thing is the risk management conduct. There's a lot of confusion when it comes to risk management. And what is the proper risk management conduct that the broker should use? Now let's dive into the first topic. Option preference. First, the assets, the choice of assets, popular assets versus more appealing assets that have big media stories behind them, like the recent Ferrari IPO that was some 3 months ago. The stock came out at 56, if I recall. It went down to 40. So it wasn't really a great investment, but the media traction behind this was enormous. And people liked the story because maybe subconsciously they thought they're going to get the car if they're going to join the IPO. In addition to that, when investors have IPOs in the regular stock market, they can usually buy the stock, essentially betting on the price to go up. In binary options, you can pick a side. You can decide that the stock is a lot more hype than it's really worth, or you could also take a leverage position on betting that the stock will go up. The second choice that the traders have as a choice of instrument. You have your regular vanilla high-low option. This is a very intuitive and basic instrument for customers to use, in which they can take a direction for whatever time they would like to trade. The second instrument that we offer is the boundary option. This is for a little bit more sophisticated traders that want to take a position, and whether the market is going to be quiet or noisy, they could take a position that would profit them if market doesn't do much and it stays within the range, or if they think market is faster, they can take an out position. Also, another instrument that we offer is the touch option, which is a continuous option that you can both take a position on the direction of the market or the music of the market, how fast the market is moving, whether it's going to touch before expiry or not. The next real choice that they have is a choice of duration, the duration of the trade. We see, of course, we see a lot of the short-term trading in binary, mostly comprises of 30-second options, 1-minute option, 2-minute option, and the other extreme would be a very new and up-becoming trend now that we see end of month, end of quarter, or even end of year positions that are now getting a lot of traction. Now, the two attract very different customer profiles. The short-term traders usually trade many trades really fast and pretty smaller positions. Their lifespan is shorter because they trade really fast. The other side of the spectrum is the end of month or end of quarter positions. We see bigger trades. These are more what is perceived by the clients to be more financial instruments rather than fast binary trading. So we see a lot of that recently. The average trade would be $500, and the lifespan would be 9 to 18 months. They're both good. They just attract a different profile of customers. What we see successful brokers do is kind of have a combination of both. They get longer positions from the clients for 3 months, 6 months, and they also use short-term, not necessarily the 30-second or the 1-minute ones, but positions maybe for 10 minutes or 15 minutes to take advantage of short-term market fluctuations. Also, my personal view of the business, that now the business has started to offer many options, and I hear now all kinds of new ideas of lottery trades and a variety of other exotic ideas that they want to add. But my personal view is that the offering is big. Of course, it's good to offer many assets, many expiries, many instruments. It's good to have, but our job is to help our brokers be more concise and focus on the options that really help them be successful and really help the traders, their customers, guide them to what they want and need. This is a big forest that needs a little bit, not really trimming down, but us, the dealers, helping the brokers concise and concentrate on what is the most successful and the most options that have the most interest for the clients. The next topic I'm going to touch now is commission structure. First day of economics school teaches you the very basic and intuitive notion that as prices decrease, demand increases. Surprisingly, it's true in binary options as well. Commissions in our business are derived from payouts. The payouts we offer to a variety of options. I'll give you in a number example. If an option, a high-low option, would offer 180% rate of return, so the broker on a 50-50 trade would have two trades, one winning, one losing, so each would invest $100. The loser would lose, the winner would get 180. So the broker is receiving $200 and he's paying out 180, and he keeps a $20 profit on a $200 trade, and that would make his commission 10%. So of course, if he raises the payout, going up to 190, for example, he would get the same 200, paying out $190, keeping $10 as his commission, so that would represent a 5% commission for the broker. We have analyzed one of our brokers that was using our optimizing model to see how higher payouts increase traded volumes. So lower commissions, meaning higher payouts, do two things. They increase traded volume and they attract new customers. Here you could see, as payouts in the industry on the vanilla high-low would range anywhere from 170 to the 190s. And you could see, as the payouts were raised for the clients, the traded volume started to increase. Now, of course, when you increase the payout, the commission is lower. This is really the mirror image of the last slide, representing the broker's commission. So as the broker increases the payout, decreasing his commission, the volume grows. Now, the broker's total revenue or trading profit would be represented by this square, which is the traded volume multiplied by the percentage of the commission. So here at the 10% mark, or the 12% mark, the broker traded about 45 million, and he made 12% of that, and that was $480,000 that he profited for the month. This broker was trying to introduce a new marketing campaign, and he started offering higher payouts, thus lower commissions. So the following 2 months, he was offering a much higher payout or lower commission for him. And as you can see, his trading volume more than doubled because of that. Here, his commission dropped from 12% to just 8 and change, but the volume more than doubled. It went from 4.5 to 8 to 10.5, and he made about $890,000 for the profit. He thought that it's good to have high payouts and lower commissions, so he did another trial, and he even decreases his commission to a very record low of 4%. Pretty much as a marketing concept, and he wanted to increase the volume a little bit more. So the volume did increase to 16 million, but he only made just less than 4%. And as you can see, the square is wider but smaller. So here, he actually decreased. He lowered his commission too much, and he wasn't really compensated for the additional volume traded. Here you can see pretty much the same chart, but just to make it clearer how profits changes as commissions vary. And you can see here very clearly that there's an optimal point that he should reach. In this instant, it's 8% commission for the broker, which significantly improved the very high commission that he was charging, but it was better than charging a little too low. The second thing lower commissions does is, in addition to increasing revenues, it attracts new clients. We have very clear empirical evidence that prove that point. Again, as the broker increased his payout, you see more and more, he got more and more new traders. For no real expense other than to just advertise that his payouts are higher, he got many, many new customers. But of course, as payouts for the customers increased, his commission decreased. But here, by giving a higher payout, he got much cheaper new customers, and his conversion was cheaper than traditional conversion or acquisition of new traders. Here, I hope this doesn't confuse you too much, but this is a cost comparison of customer conversion using higher payouts versus the traditional way of acquiring via affiliate programs and others. So here I was using this chart as an example on the traditional. I took the number of $400 per trader, and that's the cost of acquisition that is customary in the business. And here I plotted how much money he actually lost in revenues to get these new clients. And as you can see in the beginning, his cost per client for losses of revenue was for 100, it was 10,000. It was about $100 per new customer versus $400, which was for 100 is $40,000, and so on and so forth. So this system is very good for getting cheap conversion, but only up to a certain point, because there will be a point that is going to become too costly to lower the commission and would not really pay anymore. And as you can see here, there's an area that it's not worth doing anymore. So again, here also, there's an optimal point for the brokers to be in order to generate much cheaper conversion. This is a clearer chart of the comparison for various amounts of new traders to attract. The blue is the revenue loss because commissions were decreasing. And the orange one is the traditional cost. And these are the number of new clients. And that's the cost in thousand. And you can see here clearly that in the beginning, the revenue loss is worth it. I added another $100 for the campaign that would cost to introduce to the clients that were offering higher payouts. So, and the revenue loss per client was 100, so it was $200 per client, or 20,000 per 100 versus 40. Here it was 46 versus 80, and as you can see here, when he was trying to push payouts too high, lowering his commission, it became more expensive for the clients, for the brokers to do that, because revenue losses per client became too expensive for him to do. And in these cases, traditional conversion methods are preferred. The last topic I would like to touch is risk management methodology. There's a lot of confusion when it comes to risk management in binary options. I'll start with the good news. Trading risk practically doesn't exist in the binary industry. The trading risk is the total broker's P&L at the end of the day. So if we look on a monthly basis, their P&L in the binary industry is very, very steady because there are hundreds and hundreds and thousands of trades per day and hundreds of thousands of trades per month. The numbers always even out to gravitate to the 50-50 line and create very low P&L volatility. So as you can see, this is one of our clients that we were analyzing, and his profits were very, very steady. They were not identical in every month, but if he was averaging about $500,000 per month, it fluctuated very, very little. In comparison, the Forex industry could very easily finish a month in trading losses, and in some cases, even a year. So risk for binary brokers is close to zero. It's not really a risk of losing, which in our experience never happened. Of course, if you have a brand that did 2 trades a month and the customers happen to win, but over a certain critical mass of trades, brokers never lose on a monthly basis. They could have a bad day, but never a month. The risk management is really about 3 layers that we focus on. The first layer, and the most important layer, is the broker's total P&L. And as I showed you before, the broker's P&L at the end of the month hardly fluctuates and is very, very steady. Of course, we can control everything. We can control the amount of profit. We control the quality of execution for the clients, the speed of execution, the price that the client gets, the exposure that he gets. So we can control all of these parameters to pretty much use like a volume button to adjust the broker's profitability on a general level. The second layer of risk management would be groups. Groups comprise of 2 basic kinds of groups. The premium groups, the gold, platinum groups, and these groups are good clients, usually big deposits, and we treat them always with higher exposure. We give them premium payouts. We give them good executions, big exposure. So these are the groups that we promote, and we give them the best trading terms. The other side of the spectrum would be high-risk groups. As everybody knows, of course, in the business, there are some riskier groups, perhaps groups that are using robots. Most robots are not that successful, to say the least. But again, some of them are more sophisticated. They go for more challenging priced options, illiquid assets, or complex instruments like boundaries, which is a little bit trickier to price. So they're treated differently. They are treated as a higher risk group. They get restricted in the amount of the exposure they can take. Their execution is not as good as the other group. And the prices that they get are being closely monitored by the system in order to control this group that represents a risk for the broker. The last layer is the individual performer. The individual performer are risky traders that have a trading pattern that is suspicious, and they keep winning and winning big. And they get individual attention from the broker, and for us, the risk manager for the broker. Well, there are performers in the business. There are clients that deposit $1,000 and keep winning and gets up to $100,000 or $20,000 or $50,000. We've seen it all. All brokers experience that. They do exist in the business. However, their numbers are very, very, very few, and I'd even call it insignificant. Our statistics show that out of 1,000 customers, only 9 perform over a period of 3 months. And by performing, I mean they have multiplied their deposit by 3 times, by 5 times, by 50 times in some cases, or they made a big sum of money. So we tracked these guys. They're very few, they do exist, and when we analyze their activity, we try to distinguish their trading pattern to see if they're really risky or not. From our findings, out of the 9 guys here, 7 guys are just lucky. There's no trading pattern. They got lucky, and they're winning. One guy, this guy here, he's skillful. He knows what he's doing. He's abusing the system. He needs to be watched very, very carefully. And perhaps in some cases, even shown the door. The last case, the 9th person in that group would be this lady. And I would call her a question mark. The question mark is that I'm not sure she's lucky. I cannot see an abusive pattern that I'm aware of, but there's always smarter and new inventions than us. So I'd put a question mark on this pattern of trading that I don't recognize, and I would follow her closely to see maybe we can learn something new from this lady, a new pattern of trading that we didn't think exists. They're rare, but this is the last person out of the group of 9 from 1,000 customers. Essentially, total experience is the trading preference of the client, the commission that we charge, and the risk management methodology. What we do is we work hand in hand in brokers to tailor-make the trading offering to optimize their business. Now, if you didn't understand what I was saying here today, or parts of it, that's good. Let us do it for you. Let us manage your success. We are currently in the process of really renovating brokers' activity to help them make more money, acquire new clients, and avoid dangers or business mistakes that they can unwillingly do. Thank you, ladies and gentlemen.